Hello, everyone, and a really warm welcome. Thanks so much for clicking on the video today. We're looking at a true giant, Johnson & Johnson. They are trying to become the first healthcare company in history to actually crack $100 billion in revenue. But how do you grow something that's already that huge? Let's get into it.
It is a massive goal, and they're calling 2025 their catapult year. So before we jump into the Q&A, let's just quickly look at the scoreboard. They just posted Q4 sales of $24.6 billion. That's up about 7.1%.
Okay.
And for the full year, 2025, they hit $94.2 billion. And now, looking ahead to 2026, they're guiding for, around $100.5 billion.
Around $100 billion. That's as much a psychological barrier as it is a financial one. Is this just inflation, or are they actually, launching new things to get there?
No, it's real volume growth. The CEO, Joaquin Duato, he's really banking on what he calls a new era for their innovative medicine division, specifically in oncology with heavy hitters like Darzalex and Carvykti, and also their medtech business.
Medtech, right. That's the cardiovascular tech and the surgical robotics stuff.
Yes, exactly. Okay, so let's dig into the Q&A, because that's really where the analysts tried to, poke some holes in this whole catapult theory.
Yeah, that's where the good stuff is. A huge part of the questioning seemed to focus on the drug pipeline. It felt like analysts were a bit skeptical about how they actually bridge that gap to double-digit growth.
Right, and management's answer was pretty bold. They're expecting their oncology portfolio alone to hit $50 billion by 2030, but the nuance there is interesting, especially with their multiple myeloma treatments.
Yeah, Assad Haider from Goldman Sachs asked about that.
Well, it was Terrence Flynn from Morgan Stanley who asked about the positioning. He asked how they positioned two similar drugs, Tecvayli and Carvykti, without them just cannibalizing their own sales.
Yeah, that's always the danger, isn't it? So how are they splitting them up?
It's all about the setting. Jennifer Taubert from the medicine side, she explained that Tecvayli is for community settings, think local clinics, while Carvykti is for curative intent in more specialized centers. They also mentioned getting an FDA priority review voucher and focusing on MRD endpoints.
Okay, pause right there. MRD endpoints. Break that down for us.
Sure. It stands for minimal residual disease. So in plain English, they're not just looking to shrink tumors anymore. They're trying to measure if even a single cancer cell is left hiding out.
Wow.
And if the FDA accepts that as a standard for approval, it could speed up drug development massively.
Got it. So deeper remission means faster approvals. Okay, let's switch gears to the machinery. MedTech. Larry Beagleson from Wells Fargo, he seemed worried about the market cooling off, specifically the expiration of ACA subsidies.
Exactly. The logic is if people lose insurance, they get fewer surgeries. But MedTech leadership, Tim Schmidt, he played it pretty cool, said they don't expect a material impact. They're really betting their growth on new tech.
So things like the Ottava surgical robot and their cardiovascular platforms, rather than just the market getting bigger.
That's the idea. They see acceleration in 2026 driven by things like Varipulse, which is a new catheter.
Speaking of medtech, Joanne Wunsch from Citibank asked about their vision care business. It seemed a little soft.
Yeah, they admitted to some weakness in the Asia-Pacific region, but they countered that by pointing to really strong U.S. demand for their premium intraocular lenses.
The high-tech lens replacements for cataract surgery.
Exactly. Things like the new Technis Odyssey launch.
All right, let's talk about some of the boring stuff that actually moves the needle. Logistics and legal. Vamil Devan asked about the J-code for their new bladder cancer drug, Inlexo. Why does a single code matter so much?
Well, it sounds bureaucratic, but it's absolutely critical. A J-code is basically the billing tag that lets doctors get reimbursed by insurance for giving the drug. Without it, clinics won't use it. They're expecting that permanent code in Q2, which should unlock a lot of sales.
Right, makes sense. And then, of course, the elephant in the room, the talc litigation. Shagun Singh from RBC asked about the Dobert ruling. What did that mean for them?
So a Dobert ruling is where a judge decides which expert witnesses are scientifically reliable enough to testify in court. This recent ruling wasn't in JNJ's favor on some of their experts. The CFO, Joe Wolk, said they are appealing it. But the main takeaway was his tone. He just kept emphasizing that the business is undistracted.
Blinders on.
Basically, the strategy remains unchanged.
Okay, finally, there was a lot of scrutiny around their new blood thinner, Milvexian. That's a super crowded market. Why are they so confident?
It all comes down to the safety profile. Their R&D head, John Reed, he claims it has 10 times the potency of competitors.
10 times.
10 times. but with a better bleeding profile. And that's the main side effect everyone worries about with blood thinners. They're expecting data on that late in 2026.
So bringing it all together then, J&J is stepping into 2026 with some serious momentum. They're aiming to be the first to cross that $100 billion line, and they're fueling it with high-tech oncology and surgical robots, all while, trying to brush off these massive legal headaches.
It's definitely a pivot point for them, and I think the big question to chew on is this. As they push harder into robotics with Ottava, they're moving from being just a healthcare company to, well, a tech company. How does that change their culture and their competition with, Silicon Valley?
That is a fascinating battle to watch. Thanks for watching, everyone. If you found this breakdown helpful, please do click like, share the video with someone, and subscribe to stay tuned for our upcoming content. We'll see you next time.